In this video, I'm going to share with you how I'm going to get paid to agree to buy a stock that I already like at a discount. It's called a cash secured put, and I'll break it down like you're a newbie. I'll walk through a real trade, and I'll show you how I set aside a portion of the profits to pay my taxes. Okay, here's the plan. First, we're going to talk about what a cash secured put option is. Let's talk about how it generates an income, either weekly or monthly. Then I'm going to talk about a real cash secured put option trade that I made myself. I'm going to show you the chart, perform a profitability analysis, and then you'll actually see where I execute the trade. And if you haven't joined my free school community yet, what are you waiting for? It's where I share upcoming option trades, as well as you get early access to my YouTube video. Just head on over to school.com/simpleoptiontrading. I'm going to leave a link in the description down below. First, we need to talk about what is a cash secured put. And I'm going to explain it using an analogy or an example so it makes it easier for everyone to understand. So let's imagine you have a friend that's going to be upgrading their phone and they're willing to sell their old phone for $500. And because you're their friend, they're going to give you first crack at it. Well, you think about it and you decide, you know what? I'm willing to pay you $450 as long as you sell me that phone within the next 2 weeks. But in return for me waiting those 2 weeks and setting aside the money, I want $20 up front for making me wait and to reserve my money. Now, if your friend takes you up on the deal, they'll pay you the $20 because that'll guarantee that they can sell their phone within the next 2 weeks for $450. Now, the friend advertises their phone, they may not get any offers, in which case the friend is going to exercise that option and take you up on your offer and sell you their phone for $450. But if within the 2 weeks your friend actually finds a buyer for their phone, then your friend can sell their phone and the contract between you and your friend will expire worthless at the end of the 2 weeks. And so your obligation to buy the phone is no longer there. You keep your $400 that you had reserved ready to buy that phone, plus you keep the $20 that you received initially when you made the deal or that contract with your friend. Selling a cash secure put option is very similar. You're guaranteeing the seller of a stock that you're willing to pay a certain price, the strike price, for their stock within a certain time period, and that's the expiration date. Now, in return for guaranteeing that you'll buy their stock and reserving your cash as collateral, you're going to receive a payment from the buyer known as the premium as compensation for reserving your money. And this is what a cash secure put option is all about. That money you receive as the premium payment is your income. So when you sell the cash secure put option contract and you're paid the premium for it, that money gets deposited immediately into your trading account and it's yours to keep forever. And it doesn't matter if the market price dips below the strike price and you're assigned the shares and required or obligated to purchase those shares, you still keep the premium. But also if the market price finishes above the strike price on the expiration date, that option contract expires worthless. You're no longer obligated, but you still keep the premium payment that you received. I recently created a video for my school community where I shared the details of selling a cash secure put option contract. I walk through the charts, do a profitability analysis, and show the outcome of the trade. Let's go ahead and replay that video and share this important information about selling a cash secure put option contract. Let's go ahead and take a look at a daily chart for stock symbol CONY going back about 5 months. Now, I've set up the daily chart with a couple of indicators that I want to point out. So we can see the candlestick indicators here, the red and green candles, and they tell you the price movement for that particular day, right? So green candles mean that the stock price started at one point and ended higher than what the opening was. And then a red candlestick tells you that the stock price finished below the opening price for that particular day. Now I've got the Bollinger Band marked out here. You can see the upper and lower limits, kind of this bluish cloud figure you see that surrounds the candlesticks. So that tells you where the price is. And right now we can see the stock price is trading near the lower end of the Bollinger Band, or the bottom side of the Bollinger Band. Now the support level I have right around $6.45 and the resistance at $10.46 per share. And so this is kind of where the stock has been trading at for the last 5 months, is within this range. So as the price approaches the support level, it tends to go back up, and as the price reaches the resistance level, the price tends to come back down. There's no guarantee that the stock price will continue in this fashion, but it gives you a pretty good indicator of what's been happening with the price. Now you'll notice that the RSI, the relative strength index, tends to correlate with the stock price and the Bollinger Band. So for example, if we see here where the stock price is exceeding the Bollinger Band, so it exceeds the upper boundary of the Bollinger Band, well, the RSI value is actually above 70. So that tells you that the stock is in an overbought condition. And using this information, there's a high probability that the stock price will dip to get back into this Bollinger Band range and have the RSI level, the relative strength index, come back down and recover from this overbought condition. Likewise, if the stock price exceeds the lower level of the Bollinger Band, as in here, you'll see that the RSI also dips below, telling you that the stock is in an oversold condition, and that there's a likelihood that the price will move back up as more individuals purchase the stock, following the laws of supply and demand. As there's higher demand, then the price will tend to go up as well. And we can see that here as the price starts to climb up and reaches above the lower edge of the Bollinger Band. Now, what I like about this particular chart, we can see symbol CONY. We can see the stock price trading at the lower half of the Bollinger Band. It was recently in an oversold condition. And also notice that there's two areas, one here and one here, where the stock price actually gapped down. So the difference between this price here on this day and the price here, there's a huge gap. And there's also another gap here. Tells me that potentially this stock price could go up and want to fill those gaps again. And so I'm looking at a possible condition where, yeah, it's currently trading at $7.05 per share, but this stock price with these indicators, lower end of the Bollinger Band, the lower portion of the RSI, meaning it's in an oversold condition, and there may be more interest in purchasing shares, thus driving the price up, plus the fact that there's two gap downs may indicate that there may be further interest in purchasing shares and driving the price higher. So I'm going to use this information, the current stock price with those indicators, to help me decide to sell a cash secure put using a $7 strike price, because I think the price will start to move higher and my option contract will actually expire worthless, freeing up the money I have reserved for the shares, plus I also keep the full premium payment. After reviewing the technical information on the chart, all the pricing and indicators, and the strike price for the cash secure put I'm interested in selling is $7, it's now time to perform a profitability analysis to see if it makes sense. Well, let's go ahead and run this one through my cash secure put analyzer and see what the results are. So today's August the 19th, and we're talking about symbol CONY, and it has an expiration date basically 1 month out. So I'm going to use September 19th of 2025 as the expiration. Now for this trade, I'm going to be using the $7 strike price, and I'm going to specify a premium of 60 cents per share. Now let's go ahead and look at the results. So we can see I'm selling a cash secure put for stock symbol CONY with a strike price of $7. Now I'm willing to pay $7 per share for 100 shares, so that's equal to one contract. So I'm going to specify one contract. And then an expiration of September 19th, which makes the length of this contract 31 days. Now with the option strike price of $7 per share, that means I need to have in reserve $700 in my brokerage account to hold as collateral in case the option gets exercised. And if it does get exercised, well, then I'll use that $700 that I reserve to actually purchase those shares. Now I specified the 60 cents per share as the premium. As a result, if this option contract gets filled, I'll receive $60 as the premium payment. And that represents basically an 8.5% return on my investment of $700. So that's looking good, and it passes my profitability test. I'm getting an 8.5% return off a 30-day investment by selling this cash secure put option contract. So I went ahead and opened up the trading platform for my brokerage account, and we could take a look here at the trade history where I actually sold the cash secure put. You can see it here for symbol CONY. And I used the $7 strike price and an expiration date of September 19th. Now I submitted my order on August 19th at 6:59 a.m. Pacific time, and it was filled roughly an hour later, almost an hour later that same day, right? So August 19th at 7:46 a.m. Now when I sold the option contract, I specified that I wanted a premium price of 60 cents per share. And when this option contract got filled, I received a total premium payment of $60. So that's the 60 cents per share times the 100 shares because it's one option contract. Now that premium is credited immediately to my brokerage account, and it's mine to keep forever, no matter what happens to the option contract, whether it gets exercised or it expires worthless. Now with the option contract sold, I just need to wait for the expiration date to find out the final outcome. But in the meantime, I keep the premium that I collected, remember the $60, which gave me an 8.5% return over that 30-day period. So roughly 2% every week, which more than meets my criteria for profitability. So every time I sell a cash secure put, I collect a premium payment that gets deposited immediately into my trading account, and that money is mine to keep forever. Now it's not free money. I'm making an obligation to buy the shares if the market price dips below my strike price. And because we're talking about premium, from a tax standpoint, it's considered ordinary income. And so I always set aside 25% and reserve it to pay my taxes. That way, at the end of the year, I'm not scrambling to come up with the money to pay my taxes. Hey, so I thought that was a pretty good video. I shared with you how a cash secure put works, how I evaluate a stock and the options associated with it, and how I sell an option to generate an income. Hey, if you haven't done so yet, be sure to join my school community. It's where you can get early access to my YouTube videos, and you can also see my trade alerts. Thanks for joining me on this video. I hope you discovered more about cash secure puts and how you can use them to generate an income. I'll see you in my next cover call and cash secure put video.